When the bond market is going up, it's a good chance stocks are going down. Interest that you're paying is called servicing the debt. I'm servicing the bond until it comes into maturity. Now we have an issue. Now they're saying, yo, something could break, something could break. And the reason why they're saying something can break is because if that bond gets high like that, then that means a lot of money is being paid, and we can't afford that. How do we get this situation right? Okay, here's what we gotta do. We gotta release or pause the tariffs on everybody so that what? So that the bonds can come down so that people can go back to doing businesses. All right, y'all, listen, stocks are the pretty face that the financial world wears, but bonds are the heart and soul of the American economy. And today we're gonna talk about why bonds are so important, what's their importance in the economy, and why you need to know about them, y'all. Like, if you really truly locked in on the stock market, like, and you understand like why they talk about the 10-year yield so much. Like, this thing controls interest rates, it controls funding, it controls what your house note is, your car note is, what you paying on your credit cards. If you take the stock market serious, you definitely want to check into this video, because when the bond market is going up, it's a good chance stocks are going down. And I need you to pay attention to this, y'all. This is going to help you navigate. Listen, it's your boy, the Wall Street Chapman, man. You know, my goal is to help you build wealth. My goal is to help you navigate the markets, and my goal is to help you turn your last name into an asset. So listen, man, before we get into this video, I want you to like, I want you to subscribe, and share this with me. I would appreciate that so much. But ultimately, I want you to get in the comments, man, and tell us exactly how this video helped you, but also how can we help you a little bit more. Let's get into it. So, man, we talking about the bond breakdown right now, Trap. So, like, essentially, what are bonds? Let's put it like in this situation, right? Like, a bond is a debt, right? So we're gonna use this for like an easy little breakdown. So I'm in my building right now, right? And let's say I wanted to get a loan, but I didn't want to go to the bank, right? And I needed $1 million to get this building where I needed to go at. And so let's say I had 10 bonds for $100,000. That's right. So if I had 10 bonds, if I'm issuing 10 bonds, which is 10 debt issuance, meaning these 10 bonds equal $100,000 and they all worth $1 million together. So let's say I say, listen, everybody who buys this bond, the rate that I'm gonna pay you on this bond is 10%, right? So let's say on each bond, I'm paying 10% annually, and the bond matures in 3 years. So that means every year I pay you 10% of $100,000, which is what? $10,000. And then at the end of the term, I give you your $100,000 back. Yep, that's how bonds work. Now, of course, you're not gonna get a 10-year coupon on nothing. You know what I'm saying? But I'm using the easy math so we can understand. So I want to get $1 million. That's 100,000 times 10. I'm giving everybody who buy these bonds a 10% coupon, meaning I'm gonna give you 10% every year until the bond matures, right? So that means the first year I'm gonna give you 10%, I'm gonna give you what, 10,000? The second year I'm gonna give you 10,000? That's right, until the bond matures. Why do people do that? Why do companies do that? Why do countries do that? Because they use that money to build, and then once the build that they're building out starts to generate revenue, they can pay that. But the interest that you're paying is called servicing the debt. I'm servicing the bond until it comes into maturity. So now that we got that under control, let's take it to the next level, man. So for the most part, who buys bonds when it comes to America? Now, bonds make up, to me, I always said, bonds are the nervous system of America. That's right, they are the nervous system of America. You know why? Because America issues out bonds. Our largest bond holder out of everybody is the Federal Reserve. And then it's the people of America. Your 401ks, your pension funds, your retirements, that's the majority of our bond money. Now, our two biggest outside of America is Japan, that owns about $1 trillion, and then China, who owns about $790 billion worth of bonds. And so a lot of times what America does is when it's time to pay that bond, what they do is refinance, they reissue that bond. That's important for you to understand. Interest rates are set by bonds. So there's this thing called the Fed fund rate. We're going to talk about this today. It's the 10-year note. Now, of course, everybody heard about Donald Trump getting on the thing and saying, yo, we going to do this 90-day pause, right? And, you know, I came on my thing and said, yo, he had to pause because the 10-year note got to 4.6, meaning the interest rate on that note was 4.6%. That is really, really high. That means it's expensive to do what? Service debt. Now, why does that make sense? Let's paint this picture. So America sells bonds. They do what's called a bond auction. In that bond auction, banks, institutions, and other countries come to buy the bonds. Now, as long as the bonds have a low interest rate on them, which is a return rate, which is 3.9, 4.1, something like that, it's cool, right? The thing is, though, when no one wants the bonds go up in price because they have to make them more attractive. The more people buy the bonds, the more the bonds going to go down. And so this is how your 10-year note, your 10-year treasury starts to fluctuate in price. Well, Trap, how does that make sense? Well, if our 10-year is not attractive and it's the bond that we sell the most, you have a 30-year, 20-year, 10-year, 5-year, 2-year, 1 month. You won't know why Warren Buffett made so much money? He was buying 30, 60, 90-day bonds, getting that premium on it. All right. So if nobody wants to buy our bonds, then now, watch this, that bond rate goes to going up. Now, well, Trap, why does that make sense? Well, if the bond goes over 4.6, 4.7, 4.8, 4.9, that means everything is truly expensive for us, the American consumer. That means, watch this, y'all. That means mortgage rates go up, so that means home buying slows. That means car loans, business loans, credit cards, they go up. So now that means what? Spending slows. Companies borrow less. So what does that mean? Growth slows. So if you listen to the market, you hear them saying, hey, they're having a growth slowdown or they're doing that. That means something is happening here, right? And this is why they always want the Fed to cut rates, because they want rates to be low. If rates are low, America can fund the growth of America, right? Now, let's talk about this right quick. If China doesn't buy the bonds, watch me, and Japan was selling some bonds, you see where I'm going here? That drove the bond up, because now you getting your money out and this person not buying it, that causes the bond to go up. Now we have an issue. Now they're saying, yo, something could break. And the reason why they're saying something can break is because if that bond gets high like that, then that means a lot of money is being paid, and we can't afford that. We as America can't afford that. So let's go a little further. Also, it means more expensive for the government to borrow money, increasing the national debt servicing costs. So our government issues bonds, watch this, to get money to service the $37 trillion debt. So it's this cycle. They borrow money to pay the debt. So this is also why it's important that the bond stay low, because they can service the debt real cheaper. Now, let's go a little further than that. This is why it's real important for you to understand. The bond market is actually wealthier than the stock market. The bond market is worth $53 trillion, while the stock market is worth $46 trillion. So watch this. Treasuries are like government debt. So when you hear the 10-year treasury, the 20-year, these are debt for the government. But then you have municipal bonds. That's for your state and city. That's how your state and city. So you can go to like municipal, you can go to that court, the municipal court, which is that city-state court, and you can buy bonds actually from your bank based on what the city got going on. Another one is corporate bonds. So businesses use bonds to grow. Right? Now, the thing about these would be really, 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 really risky, because businesses do what? Go out of business and you can't get your money back. And then there's mortgage-backed securities, which is a mortgage-backed bond. If you think about the 2008 crisis, This what it was behind. They were selling bonds, mortgage-backed securities to people who couldn't afford it. And they just kept passing it off, passing it off, passing it off. Somebody had to collect. This is a bad deal right here. Next, I want you to understand something. Bonds equal government and bonds are bought mostly by the government, big companies, and institutions. So what I mean institutions, we talking about your Goldman Sachs. We talking about your Morgan Stanleys. We talking about your retirement funds. We talking about your pension plans. That's who buys the bonds. Stocks represent ownerships in companies, but bonds represent debt, and that is where the real money is. The real money is always in bonds. So let's go a little deeper in that situation, right? Now, when we think about bonds, I want you to think about it like this, right? So people are like, man, Trap, man, like, why would, that ain't why we got out of the situation with Trump. And I said, listen, it wasn't even that for me, because I like numbers because numbers don't lie. We're watching a counter punch each other with China and America. And let's talk about that for a second, right? So here's what happens, right? China understood for a fact, if you're going to raise those tariffs on me like that, right? One of the things I can do is I can stop buying your bonds. And if Japan sells the bond, that increases the price. Well, what America has to do is say, okay, how do we get this situation right? Okay, here's what we got to do. We got to release or pause the tariffs on everybody so that what? So that the bonds can come down so that people can go back to doing businesses. So the 90-day pause is about letting people do business. So what? You can have some growth so that people can start doing what? Maneuvering around, doing a couple of things. And what does that do? It brings the bonds down. Another thing, why is that important? Bonds, a good bond makes America look attractive. If America looks attractive, one thing is for sure, two for certain, America is the most attractive place to do business. So when people buy bonds in America, they're saying, I'm betting on the what? Improvement and growth of America. When people start betting on the improvement and growth of America, they don't buy the bonds. And when they don't buy the bonds, that note goes up. When that note goes up, America has to do something because we have so much debt. We are paying right at $1 billion or $1 billion something a day to service the $37 trillion debt. And what America does is they start to do what? Refinance those bonds. This is such an amazing game for us to understand because once you understand how the bond market works in America, now you understand why the 10-year note is so important. Listen, man, it's your boy, the Wall Street Trapper. Listen, man, I hope you learned a lot from this video. I hope this video was a great breakdown for you, man. I want you to go back over and listen to it, share it with somebody so you can understand. Now, it is important for you to just start looking at that bond like, yup, it's up. Yep, it's up. Oh, they got a bond auction. Oh, how did that bond auction do? So you hear about the bond auction, you know now if a lot of people are buying the bonds or people are not buying the bonds. And it's important as an American that people buy those bonds. Now, here's what I will say about that. Watch this. A recession allows the deficit to come down because then the 10-year note crashes. If the 10-year notes come down, everything is cheap. The cheaper that get, the easier it is for America to serve that debt to everybody. So that's another thing why people are saying, he's trying to crash the market, he's trying to crash because if the market goes into a recession or the market crashes, people get scared. And then now the 10-year has to come all the way down. And it gets easier for America to service the debt and they can get out of that, man. I hope y'all understand that, man. I love it. Let me know in the chat how you feel about this video. Again, man, this is not biased. This is straight factual because I think it's important for you to understand how that bond market works so you can build your wealth one share at a time. It's your boy, the Wall Street Trapper, man. Make sure you share this out, man. Make sure you tell us in the comment. But last but not least, man, that's not me telling you about WhatsApp and all that. So make sure you don't fall for that, man. I love y'all, man. Salute.